Today, major developments are reshaping the global crypto and macro landscape, from a breakthrough in blockchain reengineering to new signals of economic slowdown, fresh Federal Reserve commentary, and one of the biggest policy shifts from a major US investment giant in years. All the events could have profound implications for digital assets, including the internet computer. What do you think these moves signal? And drop your early thoughts in the comments. Over the past year, markets have defined by high interest rates, slowing growth, regulatory uncertainties, and rapid innovation in Web3 infrastructure. But this week, regulatory uncertainties and rapid innovation in Web3 infrastructure mark a convergence of several major storylines. We've got a direct comparison of L1 blockchains based on the code bases powering their core clients. We have Vanguard reversing its long-standing stance on crypto investment products. A live demonstration of the internet computer interacting natively with another blockchain. Cautionary signals emerging from the US labor market, and a renewed debate about potential federal rate cuts and even yield curve control, and a new regulatory update on stablecoin oversight. Each of these new developments carries its own narrative, but taken together, they paint a larger picture about where digital assets and macro policy may be heading, because macro drives everything. Do you think all this points to a turning point for the market? Let us know below. A new comparison across major layer 1 blockchains offers a surprising look into the scale and sophistication of each protocol's underlying architecture. The findings were based on the approximate number of lines of code in each network's main client. And the internet computer, we're talking 1.1 million lines, more than double compared to Sui, Solana, Aptos, with Near having a third and Avalanche having a quarter of that. While lines of code aren't a measure of quality on their own, they do help illustrate the relative complexity and feature breadth of each network. ICP's codebase stands out dramatically, suggesting a broader execution environment, more integrated systems, and fewer external dependencies, compared to chains that rely heavily on bridging layers of off-chain infrastructure. So, when we look at this from a technical standpoint, this raises an important question. Are investors undervaluing the long-term potential of networks with massive in-depth native capabilities? What's your take on this? Share your view in the comments below. And another major story comes from an unexpected technical achievement. An internet computer, a canister, essentially a smart contract, engaged directly with Tron's blockchain. What makes this remarkable is that it's done without conventional bridging systems, wrapped assets, or intermediate services commonly used across the crypto industry in general. The interaction occurred natively with programmatic control operating directly on the other network's mainnet. This form of integration represents a different model for Web3, one that truly relies fully on chain compute rather than external bridges or operators or centralized servers in that case. If scaled, this approach could reduce some of the most common failure points across crypto infrastructure. Do you agree that native cross-chain functionality is a major step towards Web3? Tell us below what you think. And a significant policy shift, Vanguard, a major US investment firm, known for its conservative approach to investing, is now enabling access to cryptocurrency ETFs and mutual funds on its platform. We're talking trillions here with Vanguard. Effective immediately, retail investors can buy and hold these products directly through Vanguard's brokerage services. While this does not imply a direct endorsement of any particular asset, the decision, though, broadens the availability of regulated crypto exposure to millions of customers who previously lacked access to the crypto markets. And for a sector historically constrained by limited institutional on-ramps, the move adds credibility and removes friction at the same time. Do you think Vanguard's decision signals broader institutional acceptance? Let us know in the comments. Okay. The ongoing debate around US industrial reshoring. It's a big thing, bringing manufacturing back to the US domestic soil. It has resurfaced following comments from the Trump administration, which indicated interest in expanding these efforts. And also strategists such as Jason Besson have argued that sustained reshoring is unlikely unless long-term borrowing costs fall meaningful. With the 10-year US Treasury yield hovering at above 4%, manufacturing expansion becomes more expensive and less competitive. And the latest US ISM manufacturing reading for November remained in contractionary territory. Historically, readings at this level have coincided with downward pressure on yields, but so far, that shift hasn't materialized. And it's only a matter of time, not financial advice. And this is where the decision around yield curve control, or YCC, re-enters the picture. Under yield curve control, the Federal Reserve will act to hold long-term yields below a target level, reducing borrowing costs for businesses and governments alike. And I do believe that yield curve control in some sort of form is inevitable for the US government to tackle this growing debt and deficit problems. We were talking about 6%, deficits to GDP. So for assets like ICP, whose valuation historically benefits from lower discount rates, and policies that compress long-term yields tend to be supportive. Also, crypto markets broadly react positively when liquidity expectations ease. And this is a form of liquidity mechanism that's positive. So do you agree that a push towards yield curve control could be supportive for digital asset valuations? Share your view below. I definitely know there's a correlation towards that. And new data from consumer surveys show that Americans' perceptions of the job markets are deteriorating. The gap between respondents saying jobs are plentiful and those saying jobs are hard to get narrowed to 9.7%, one of the lowest readings in 4 years. Historically, this metric has been one of the earliest leading indicators of rising unemployment. Furthermore, continuing jobless claims rose to 1.96 million in the week ending of last week. That's the third highest reading since late 2021. These trends suggest that finding work is becoming more challenging for many Americans. We can put that part to a large tranche of that to the AI productivity boom starting to pick up, reinforcing expectation that the Federal Reserve may need to ease policy sooner rather than later. Do you think the labor market is signaling a policy pivot? Let us know your thoughts below. Given the cooling labor market and slower manufacturing activity, analysts increasingly expect the Federal Reserve to resume rate cuts. Lower short-term rates generally reduce the discount applied to risk assets, including digital tokens like ICP. Historically, crypto has responded faster than equities when liquidity expectations shift. This is because digital assets are highly sensitive to changes in real rates and liquidity flows. For networks like ICP, with combined compute capacity with token-driven resource, pricing rate cuts can reduce the cost of capital for developers and enterprises to build application. Increase the attractiveness of alternative assets relative to cash. Cash becomes trash in that environment. Expand risk appetite across the market. Which scenario do you think is more likely? A faster pivot or a prolonged high rate environment? Share a perspective in the comments, but obviously if you look at the SOFR rates, if you're looking at the credit market dysfunction that is happening, prolonged high rates are not sustainable. And in recent statement, Federal Reserve Vice Chairman Michelle Bowman confirmed that US bank regulators are actively developing updated rules for stablecoins. So they need clear regulation that could benefit blockchain ecosystems that offer secure, programmable environments for tokenized assets. And the Internet Computer's architecture is included in its native ability to host decentralized financial logic without intermediaries, position it well for an environment where regulated stablecoins require transparent and verifiable infrastructure. Do you think new stablecoin rules will accelerate blockchain adoption? Drop your thoughts below. Search trends and online engagement show a declining interest in many of the topics that dominated crypto discussions earlier in the year. Retail participation has pulled back significantly, often considered a classical indicator of a market bottoming conditions. Historically, enduring bull cycles have begun at moments where retail sentiment is at its lowest and institutional positions begin to shift silently. Do you believe we're nearing a market bottom? Tell us in the comments. Economists and market strategists broadly share concerns about persistent high yields. Several analysts argue that without intervention, elevated long-term rates could undermine domestic manufacturing goals. Many strategists summarize the challenge as follows. You cannot have a competitive reshoring agenda with 10-year yields above 4%. Something has to give. Even labor market experts warn that softening sentiment among workers has historically been a leading signal for broader economic cooling, often preceding increases in unemployment. And with the AI productivity boom, that is only going to accelerate through 2026 in regards to weakening labor market. And regulatory experts note that stablecoin rules could provide much needed clarity to banks and fintech companies looking to engage with tokenized assets. Blockchain engineers emphasize that native cross-chain capabilities, like those shown by ICP's recent demonstration, represent a long anticipated evolution in blockchain interoperability. What quote resonates with you most? Share your thoughts below. Across these very developments, one theme emerges. Okay, we're looking at the intersection of macro policy, regulation, and blockchain innovation is accelerating. If yields remain high, reshoring becomes less feasible, but if the Fed intervenes, and that's inevitable, not financial advice, risk assets may surge. So if the labor market weakens, which it has been weakening, AI productivity boom most likely accelerate, rate cuts may arrive sooner than later, historically bullish for crypto. If stablecoin clarity arrives, enterprise adoption could accelerate. If native cross-chain infrastructure scales, Web3 could shift away from bridges and wrapped assets. And with institutional giants like Vanguard opening the door to crypto exposure, access expands dramatically. So combining these forces could reshape the competitive landscape for layer one blockchains, especially those that have deep native capabilities such as the internet computer. Here are the key questions for the viewers to know. Which macro scenario do you think plays out first? Rate cuts, yield curve control, or prolonged tight policy? If I were to say, I would say rate cuts. Do you see native cross-chain execution as a major breakthrough? Will Vanguard's decision accelerate institutional adoption? Are stablecoin rules bullish for blockchain networks? And do current sentiment trends signal a market bottom approaching? Share your thoughts in the comments, and your perspective helps drive the conversation forward. Thanks for joining us in this in-depth analysis of the shifting dynamics across crypto policy and the global economy. Because the global economy and the macro drive everything. And I know obviously we're interested in ICP, we're interested in the technology, but having the foresight and understanding of the macro expectations, that's what prices everything going forward. And if you found today's report helpful, remember to like the video, subscribe to the channel, and share it with others who follow these developments. And don't forget to drop your comments below. I read every one of them. And until next time, stay informed and stay decentralized. And I'll see you on the next report. And I'll see you on the internet computer. Peace out.